You're listening to the Best Advice Podcast, guys. If you haven't already, give us a 5-star review and help spread the word. And if you have a question for the guys, email a voice recording to podcast@bestadvicepodcastguys.com. That's podcast@bestadvicepodcastguys.com. Today's episode is brought to you by Security Financial Management. If you're ready to level up your financial game, SFM offers a free initial consultation after each episode. Just send an email to podcast@bestadvicepodcastguys.com with the subject line complimentary consultation to book yours today.
Ooh, welcome back to Best Advice Podcast, guys. I'm your host, Rob Lovaglio, here as always with Fatz Jacks and Mitch. Gentlemen, what's cracking like it?
Holiday, July 4th.
Holiday's cracking.
They're all-American week this week. July 4th, our independence. I'm ready.
4th of July, everyone. And hump day, right? It's Wednesday.
Weather's
This comes
gonna
out
be
tomorrow.
That's right. It is.
It's Wednesday, the day before the happy 4th, celebrating America's birth. It's great.
Uh-huh. Let's get some positive energy here with the segment. Give me something good. So, Fatz, give me something good.
Give me something good.
Happy 4th of July, everyone. We already talked about it, but Erica.
Happy Beer Day. How from zero to America? How free are you today, guys?
Pretty free. It's going to be it's going to be great.
From 1 to America, how free are you today?
We're free. We're very free.
Well, let's jump right into it with the question of the day. Today's question comes from Luke from Maitland. Luke, what you got for us?
You want to say something?
Short and sweet, guys. Luke wants to know, what is the rule of 72?
Thank you, Luke. All right, Mitch, take this one off for us.
Well, the question is, what is the rule of 72? You've probably heard about it. Most of you might have known what it means or what it is, but the actual real definition of the rule of 72, it's a simplified formula that calculates how long it takes for your investments to double. How long does it take for your investments to double? It comes in handy when planning for retirement, what your investments should look like. Again, you always try to figure out your suitability. Much younger, you can take a little more risk because you've got a much longer time horizon. And older people, like myself, you don't have that long time horizon, so you really have to be careful. But there's lots of rules, and it really applies to the Rule of 72 also applies to compound interest. And compound interest is what will double your money. Austin, I'm going to let you go on that.
Absolutely.
Give us the two basic ones that they talk about.
To give you an example of how it works, it basically says, given a certain rate of return, how long will it take to double that investment? So you basically divide 72 by the assumed rate of return. So in an instance, let's assume we have an 8% rate of return. The rule of 72 says that your money will double in 9 years because basic math. 72 divided by 8 is 9. So it's a very basic formula, and one thing you have to remember is that 9%, it's not going to happen every year. That might be an average. But to kind of, it's a good generic planning tool, but you have to think about sequence of returns as well. So just a very extreme example. Let's say you start with, call it $1,000, right? Money goes up 100% in year 1. Then it goes down 50% in year 2. Average rate of return is 25%, but your money's the same. Does that make sense?
It does make sense. And I know we're talking Rule of 72, but a little touch on that sequence of returns. To your point, it's extremely important of when the money goes in and what happens with the market. You can take over, I think it's a 15-year period, and the first 5 years, the market goes up, it goes down bigger, it goes sideways. And you take the exact return and just flip it, where you don't have a lot of the big losses up front. After that 15-year period, you'll both have, and using a certain number, about a 7% annualized return. However, at the end of 15 years, even though you both have a 7% return, if the money went in when the market was down, and you were spending X amount per year, you will have $0 left in one of them. And if your money went up during that time and flipped around, but you still had the same 7% return on the other side, when the market wasn't down as much, you'll have a lot more money versus zero money. So you have to be careful with sequence of returns. It's very complicated. We have that information, but it's a lot to do on a call, on a podcast like this. But just know you can talk to your advisors about it, and it's sequence of return, which you brought up. And compounding also makes a big difference.
Sure, yeah.
And in addition to compounding and the sequence of returns, when people are figuring that out, you also have to take into account inflation and taxes, because inflation and taxes will erode your purchasing power and how much money you'll have as well. So those are things that we really need to take a look at. It's not that simple, because most people know the rule of 72. If I average 7%, my money doubles in 10 years. If I average 10%, my money doubles in 7 years. And that's what they think about. But they forget everything else.
Do you, in a great situation, or what's your goal? How many times do you want your money to double? Obviously 100 times, but what's realistic?
Well, it depends when you start. If you start at, which if you could, at 25 years old, you can double quite a bit. If you start at 60, that's going to hurt your doubling ability, because, if you just get a 7% return in 7 years, your money will double at 67 years old. But are you going to have to start taking money out? Remember, the rule of 72 is you're not really taking anything out. You're leaving it there. Taxes aren't coming out. Compounding, inflation. So it really matters. And of course, it gets back to start when you're young, or as young as you can, but don't get discouraged if you're saying, okay, I'm 58 years old. What do I do? Start investing. Invest whenever you can.
There's
but
a
the younger,
misconception that I also was a part of it, was that, investing, you need money to invest. Like you need like 50 grand to invest or start your retirement fund, when really it's
$50.
$50
if you're young.
And just
Put anything
consistency and that kind of dollar cost averaging will kind of help with the scenario you gave earlier with what'd you call it when you put in money at the wrong time, and the
sequence of returns,
right? So you can do dollar cost averaging, which is you can put in $100 a week, $100 a month, and it's going to kind of take away that liability, and then also your money's going to double.
Absolutely. Absolutely.
So, obviously the greatest thing you could do is start when you're younger, no matter how much you possibly could put in. But don't get discouraged if you're not able to do it until you're a little older. The key takeaway is do it.
You can do it.
Do it. And the rule of 72, a lot of people, here's your trivia question of the day. It's been around. It started 2 years after Columbus discovered America in 1494 by another Italian.
I'm Italian.
Luca Pacioli. Luca Pacioli in 1494 referenced this rule in a comprehensive mathematics book called Summa de Arithmetica. There you go. That was my Italian.
I don't think
for the
stocks
day.
were around then, though.
I'm Italian.
Yeah,
Yes.
you are.
So that's when it started. So it's been around for a long time.
Very cool. I didn't
But
know that.
yeah, so lots and lots of things. But again, compound interest is key. Taxes are key, and investing at any age is key.
All right.
That's what it takes.
That's where you summarize that for Luke. Rule 72. What's the big picture here?
Big picture, Luke, it's a very basic planning tool. You take the number 72, divide it by the assumed interest rate. That tells you when your money would double in a compounding interest scenario. That being said, there's a lot of other factors at play, like sequence of returns, the amount that you're adding. I mean, we try to bring it back to the planning and investing and really creating those habits of invest what you can as often as you can. And, compounding interest will help you build wealth slowly over time. But Rule of 72, very basic planning tool. There's other factors to consider, though.
I just also wanted one other thing on that. Remember, though, the rule of 72, it's a rough estimate. and assumptions aren't always correct.
We're not guaranteeing
Don't.
anything.
Assumptions are not always correct.
Correct.
It assumes a constant return. The stock markets are anything but constant. They're always up and down, and the average return is always far from indicative of the return you're likely to get. So,
Great vocab word right there.
yeah, so strong word. Strong word. I've been investing for a long time, so I had to think of that. But again, it's a rough, good estimate. Things change, the market varies, returns will vary. But it's a good rule to think about and help you think about invest whatever you can.
All right, gentlemen, we are creeping up on 10 minutes now. Let's get a quick market update with a minute with Mitch. Mitch.
1 minute with Mitch.
Well, last week, the market, some good news came out. Some of the key indicators have come down. Inflation dropped at about 0.1%. Unemployment numbers are starting to look pretty low now. They're starting to really come down. We did hit that 4% mark. Remember, 5% is still considered full employment. However, we're right around 4% now. The numbers are starting to creep up. Less people moving. Remember, during the pandemic, people are going to get a job every 9 months because they needed people, and they're going for the new job for a $6,000 raise or $5,000 raise or $2,000 raise. That movement has slowed down significantly. Companies are not advertising as many jobs. So that part's slowing down. It's really counterintuitive. I mean, we're hoping for a bad economy so the Fed can lower interest rates. And we should all hope for the best economy, but in this case, the Fed's not going to move off that 5.25 to 5.50 interest rate that they raised 16 times 2 years ago, a year and a half ago. So until things really start to get bad, they're going to leave it high. So everybody's rooting for things to get bad, and we're starting to see those cracks are happening. And I think now we're somewhere around a 60 to 62% chance of a small cut in September. You know, the Fed go on vacation in August, so they take the month off. You're not going to see anything in August. They go on vacation. We have one meeting coming up in a couple of weeks in July. We don't think anything's going to happen then, but the numbers, unfortunately, are looking bad, which is a good thing.
Well, duh.
So
Bad
it
is
doesn't
good. I
make
remember
any
that.
sense. Bad is good, but things are slowing a little.
Amazing.
So
Thank
that's
you,
the
Mitch.
good news.
Appreciate it. All right, folks, remember the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed. If you have a question for the guys, email podcast@bestadvicepodcastguys.com.